Hello value investors, thank you for joining me. Today I want to talk about whether it's a good time to invest. This is a question that came up. Somebody said, oh Michael, I was quite good to get into the market when the market collapsed back in April, but I'm kind of come out of the market slightly, and is this a good time to invest? So I'm going to break down that question into three different areas. The first area is going to give a very quick overview of the different investment strategies. We'll then move on to part 2, where we talk about time in the market. Finally, we're going to go to part 3, which is investing alongside the earnings power of the company. So if you're new to the channel, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you which stocks I own and why, with balanced arguments for the stocks I own. You're welcome to do a totally free trial to see if it suits you. I have what I call the hybrid portfolio, which is certain stocks that are going slightly faster, and I've got deep value stocks that are very much undervalued. Hopefully there's a balanced enough portfolio for you to pick what suits you. So let's address the different investment styles. Some people get a bit confused and they say, oh, value is this and growth is that. Now, this has kind of become quite difficult to describe because all investing is value investing. The investor is, in essence, putting down capital today for an asset that she believes in time could be worth substantially more. That is value investing. She is making a valuation of the underlying asset and trying to purchase it at a discount to future earning power. Some people believe that value investing is just low price to book or low PE stocks, and that kind of gets people slightly confused, and I think it's much better for a person to try and understand maybe high growth and low growth. I know that's kind of not as jazzy, but I believe that that would help really cut through the noise until a better term comes up. And Warren Buffett and Charlie Munger both come up with this and say that all valuation, as long as it's sensibly done, is a value investing strategy. So rather than trying to go through, okay, I'm a growth investor, I'm a value investor, I think that it's much better to try and understand the underlying dynamics of a business. So if you have a low growth business, you're buying that business a lot cheaper, and you'd buy a few of these businesses, and you're trying to make some estimates of what that balance sheet is worth. It could be the case that the balance sheet has a lot of cash on it, or that they could be spinning off a certain asset, and you believe that if you buy, for instance, company XYZ at approximately 10 billion, that if they spin off that asset, it may be worth as much as 6 or 7 billion, and then you're kind of paying whatever is remaining of the XYZ business at approximately ballpark of 3 or 4 billion. So you might think, okay, that business may actually in a couple of years make approximately 1 billion in earnings. So you think, okay, I might be getting a bargain here because I get the business that's spun off, and I'm also getting that underlying business that stays. Possibly in 2 or 3 years, it might making 1 billion in earnings, so I'm kind of paying a PE of 4 on that business. So that kind of is a bit value investing kind of idea, that you kind of something slightly low growth, but it's kind of very cheap. The other type of investing style could be very high growth, and that also has its troubles. So you're trying to buy in 2020 a business that is high growth. This is very, very attractive for a large group of investors. Many investors are quite happy presently to do away with any visibility, any path to profitability, as long as the business is growing its revenues quite quickly. And there's a certain appeal to that. If the business is growing quite quickly, you might be thinking that in 3 years, what those revenues could be substantially higher than they are today. So if you're looking 3 years out, comparable to its peers, you're actually getting that business quite cheaply if you extrapolate that revenue growth rate. Now, of course, that gives you a lot of trouble. So the first problem is that you have no idea what the future will hold for that business, and you don't know if that business can sustain anywhere near that revenue growth rate. The third problem that you have is that everyone else is jumping on that bandwagon, and you're paying a very large multiple on the expectation that that business will continue to tick along. So it could be the case that certain businesses have always been overvalued, and look at Amazon and Netflix. These businesses have always been very, very expensive. So it actually turns out that it was a reasonable investment. No matter how high the valuation an investor got it 5 years ago, it turned out to be okay. But those are very, very few and far between investments, and not every investment is the next Netflix or the next Amazon. So with the low growth investment strategy, you have a certain set of problems, and with the high growth, you've also got a different set of problems. In summary, no investment style is perfect. But part two, it's not about trying to time the market. Many people say, the person who wrote to me said, is this a good time? I'm kind of worried about interest rates might be going up. I'm worried that the election's coming up. I'm worried about whatever the Fed movement is doing. I'm worried about trade tensions with China. So there are a lot of different problems. And in investments, there's always problems. There's always something coming up in the horizon. What is important is to try and do away with that style of trying to time the market, but it's about time spent in the market. Even if an investor makes a few mistakes, by being invested over a 5-year period, a lot of those mistakes even themselves out. So it's much better to be a participant, buying business as a business owner. The other problem with trying to time the market is that there are all these behavioral factors that we as human beings have to overcome. There's a lot of behavioral science that shows that if an investor is out of the market and the market is going up, they kind of feel, okay, I was out and I'm not going to participate as it goes higher. And conversely, if the investor is out of the market and the share price keeps falling, the investor says, I did a good thing for staying out of the market. I was a wise investor, and I'm not going to be able to get in now. So it's quite difficult hurdles to overcome by trying to be a market timer. There's a Peter Lynch quote that says, more money has been lost in trying to stay out of the market correction than the actual amount of money lost in the market correction. I'll repeat that. Trying to predict the crash actually loses more money than the crash itself. And we see this all the time happening, that if you look back to 2012, 2014, even 2015, many value investors will try and say, the market is looking too exuberant right now. You got the Greek crisis, the Arab Spring crisis, there was all kind of problems, and there was the flash crashes of 2012, and investors was like, okay, I'm a bit shaky, is the Fed gonna remove quantitative easing? So there were all kind of problems, and a lot of investors was trying to stay out of these very high quality businesses because the valuations didn't seem to make sense to them. Fast forward to 2020, and obviously that was the wrong reaction to do. What's more sensible is what we're going to do in part 3, which is to try and think as an investor, as a business owner, try to understand the business. The best way to do this is really through practice. If an investor buys a share of a business, they think like a business owner, and they're more likely to study that business, to study its peers. This is not the same to say that that the investor knows all the products that the business is doing. That is not the same. What is most sensible is to think about what is this business capable of producing in terms of earnings within the next 5 years, because the market is always forward-looking. So the market is trying to price the future earning power of the underlying business. And what sometimes looks difficult to predict, that can be arguably the best opportunity, whether it's from the low growth investments or the high growth, is really trying to see things differently from the market, because you can't try to be in the same stocks as everyone else and simply argue that I'm a long-term investor, therefore I have a longer time horizon than other people, therefore this makes sense. That doesn't always work, because a lot of people think in the same way, and everyone is a buy and hold investor for as long as the share price is going up week after week. As long as the share price is going week after week, nobody's going to ask difficult questions from the investment, and nobody's going to be willing to scratch their head and say, okay, does this valuation make sense to the underlying asset? So what is quite a more prudent way to go about it is try to understand the future earning power of the business and pay it at a discount. So you can try to pick out certain businesses. So when I talk about a high quality business, even if it's a low growth business, you're trying to find something that's very stable and predictable. This also applies to high growth. You can be a business that's predictably growing, expanding its margins over time, or if you're looking, for example, on the other side where it's a low growth business, you're looking for a business that's stable over time. There's not a lot of churn within the user base or within the revenues. The business delivers a product to a certain number of clients or enterprises or consumers, and is quite predictable. So that's really that's a very attractive business. A business that is not very attractive is a business that has a story of being a high growth business, and you look at last year's revenue growth rates and they were growing at, let's say, 80% year over year. This year they start the year growing at 60% year over year, and if you look out for the full year, they're growing at, let's say, 40%. That implies straight away that the last quarter the revenue growth rate must be dipping below 40 to bring down the average for the year. So that's an unstable business model. A business that's rapidly decelerating. It's very difficult to understand what is going to be 2 or 3 years out, because that's what you as the investor is trying to do. You're trying to see a business that can grow its earning power. And in the present market in 2020, we know that the underlying economy is not that strong. And many investors say, no, management is just lowballing the guidance. They're just saying that the management is saying, people are just deferring their purchases, they're pushing out their purchases. It just means that people are unsure. The customer is unsure. So it's very difficult as an investor to make a very strong bullish case that a company is a high growth company if the business is coming down substantially. And this also applies to low growth companies. Low growth companies that are kind of historically growing at, let's say, 9% or 6%, and all of a sudden they look like they're going to be, for a period of time, having negative growth rates. There has to be a very strong balance sheet to support that argument, because an investor has no idea of being able to ascertain the value of that business some years out, because the multiple will keep compressing. And as the multiple compresses, the sentiment starts turning quite negative quite rapidly. So today we talked about different ways of thinking about the investment strategy. We talk about not trying to time the market, but time spent in the market, and how the investor should think about aligning the investment strategy by buying high quality businesses. They can be low growth businesses or high growth businesses, and then how an investor should think about the valuation of those businesses. Hope you found this video useful. Don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own, and you might find stocks that appeal to your investment style. You're welcome to do a totally free trial. And don't forget to subscribe so you can get my next installment. And I'll see you soon.